All right, what's up, everybody? We are live. I am going over the upcoming changes the Federal Reserve is making to what monetary policy. I've got a deeper dive video coming out on this tomorrow on Friday, but wanted to answer any questions anybody has about it because it lasted a total of 12 days between when the Fed ended QT officially and restarted QE unofficially. And that'll happen tomorrow. So we'll go over that. Also, throw any questions that you have for me in the chat along the way, even if they have nothing to do with what we're talking about today. All right, so quantitative tightening, that is when the Fed's balance sheet is declining. They're letting assets roll off of their balance sheet. Roll off means money is getting paid back to them because they have a bunch of assets on their balance sheet, but those assets are just debt instruments. So it'd be like if you bought a bunch of bonds. That's what they did. They bought a bunch of bonds. They created the money to do that, but which we know would be nice. But if you in your brokerage account, if you bought a bunch of bonds, then eventually those bonds would get paid back because they would mature. If you took all that money that you got paid back when those bonds matured, and then you just went out there and bought more bonds, then that process would be like your balance sheet would remain steady. And so for the last couple of years, what they've been doing is they take, let's say they get, $1,000 paid back to them from a bond that matures. They'll take, let's say, $900 of that and then re-loan that back out, buy another new bond with it. And so they were slowly letting their balance sheet bleed down. That was slow. The balance sheet was slowly declining. That's sucking liquidity out of the system because those dollars that they don't roll back over into new bonds, they just cease to exist. A month and a half ago, they announced that on December 1st, that process would stop. And so the balance sheet would remain steady. So they just roll everything over. That lasted 12 days because at the FOMC meeting that concluded yesterday, they announced what their next plan is with monetary policy, and they are now buying Treasury bills and Treasury notes up to 3 years in maturity for reserve management because they don't want anything to happen with reserves, illiquidity issues. They want to make sure that reserves stay ample so that banks have the overnight liquidity that they need. That means that they're adding to their balance sheet, which is, they're not calling it QE because for them, if they're going to call it QE, it's going to be for general easing purposes. And so they're going to buy across the curve all the way to like the longest maturity treasuries. Back in 2019, they did the exact same thing. They were buying T-bills for reserve management purposes, for short-term liquidity purposes, but it's still adding to their balance sheet. And so whatever you want to call it, debt monetization, quantitative easing, reserve management, balance sheet is growing. That means they are increasing the money supply. Thoughts on Gold Mining Inc. No thoughts. Will the rate cut cause homes to reinflate higher? Probably not, because the rate cut, if you're watching, where is it? If you're watching the 10-year treasury, if you look at a chart of the 10-year treasury, it's going to be kind of that's kind of like the benchmark for interest rates, because if you have money that you want to get, you're thinking of locking that money up for 10 years. The risk-free place for you to put that is to loan it to the U.S. government. And right now you can get 4.1% by giving that to the government, the U.S. government, for the next 10 years. If you're going to loan that to somebody else that does not operate a monopoly on violence, which means there's a level of voluntary action required to get paid back, then you are going to demand a risk premium on top of that risk-free rate, because the U.S. government can always pay back as long as they choose to do so. It's possible they default, but very, 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 very unlikely, because it would happen through political gridlock or choice. But a mortgage holder might default because they lose their income and they can't exercise a monopoly on violence to get the money back in order to pay you back. So you're going to maybe demand 5 or 6 or 7 or 8% depending on who the borrower is and what kind of debt it is. But the reason why, like for a mortgage, we're looking more at the 10-year as that base rate to add a premium on to rather than the 30-year treasury is because most people don't hold mortgages for 30 years. Through selling and refinancing, an average mortgage is held for a lot closer to 10 years. Business loans, personal loans, auto loans, they all kind of kind of congregate around the 10-year. So the 10-year kind of operates as the benchmark interest rate for general debt purposes in the economy. Um, if you look at what the 10-year did over the last couple of days versus what like the 6-month T-bill did, the 6-month T-bill has gone down over the last couple of months. The yield has, which makes sense. It's very, very closely tied to the Federal Reserve's Fed funds rate. But the 10-year has not over that same time frame through from August. It's gone up slightly, and it's been volatile. If you look from September 8th until now, it's basically flat. It's gone up and down. It's basically flat since then, but it's not going down like the 6-month is. The 6-month yield is, or even like the 1-year yield is. And the reason why is because it's always going to be to have an influence on it from inflation expectations. Because if you expect that the dollar is going to be diluted over the next 10 years, then you're going to want a higher interest rate to get compensated for that inflation along the way. And mortgage rates are highly influenced by those free market. They're a lot more influenced by free market actors compared to something like the 6-month yield or the Fed funds rate. And so you're going to have a lot more influence of inflation protection going into determining those interest rates. Not only that, but the Fed is still actually selling off their mortgage-backed securities. They're letting those roll off their balance sheet at a steady rate. So that includes rolling over, buying, selling, just to make sure that they always roll off, that it declines. Their mortgage-backed securities decline at a very even, steady rate. And it looks like they plan to get entirely out of holding mortgage-backed securities, which will put a constant until they're out. They'll put a constant high, upwards pressure on mortgage rates. So I don't actually expect that what the Fed is doing with the interest rates right now will have any significant impact on mortgage rates in terms of pushing them down, which is why we're seeing things like the 50-year mortgage idea thrown around. We're probably going to see more like, hey, for specific types of borrowers, for specific incomes, mortgage rates. We're going to talk about maybe limiting mortgage rates to a 5% maximum or something like that. I would expect more policy on the fiscal side rather than monetary side, trying to deal with mortgages and housing, and those are addressing the symptoms, not the problems. But if you address the problems, then the homeowners that really like their equity get mad. If you address the symptoms, then it makes everybody happy temporarily until the next generation can't afford to ever buy ever. But we'll see what happens. Thanks for Tiva, by the way. Yeah, Tiva was one of the trades in my asymmetric alpha alert program. That's one of my investment research services, and we just closed that out today at our profit target. It was about a 450% profit. All right, always pay your taxes. Hypothetically, what are the ethics, moral, and societal result of having some of your income go unreported and then spending that cash into the economy? How you see fit. Okay. That is a good question. I don't know. This is kind of initial thoughts on, because I haven't thought through a good answer to this question yet. Let me first address the common idea is that taxes are a social contract. In other words, we have a contract with society to give back because it's the things like the rule of law and the roads and the law enforcement and the infrastructure that has been put in place by the government, at least in part because of some of these things, that allows us to find economic success. And so our duty is to pay for that. as a social, that's the social contract. And part of that is paying for people who had access to those exact same benefits, but for whatever reason have not yet or ever will have any economic success. The problem with that is if you never opted in and you can't opt out, it's not at least I would say morally speaking or philosophically speaking or logically speaking, it's not actually a contract. For something to be a contract, you must be able to enter into it voluntarily. And if you were forced into entering into it without a choice, then there must be the ability to opt out. And in fact, every country on earth has the ability to opt out by simply going across the border. So if you live in, I don't know, Germany, and you don't like the policies there, you don't like how they're spending your tax dollars, you could go across the border. You could move to Poland and live by their set of rules. So you still have to undertake, some decently difficult action by moving somewhere else. But you do have the ability to opt out of the system by leaving. The United States is unique in that they have global taxation, which means as an American citizen, if I go anywhere, I still have to pay taxes to the US government, no matter what, on all my income. There's a larger deduction on the first part of your income if you spend zero time in the US. But it's still just a larger deduction. It's not it's not like you can get away tax free by living in another country. You can't opt out of the system. Um, and so if you can't opt out, you never opted in. It's not a social contract, and they're taking it by force. If you don't pay, then they use men with guns to violently and forcefully imprison you for the rest of your life. And there have been people who have, like Peter Schiff's dad, died in prison for not paying taxes. Um, Now you might say, okay, well, you can still expatriate, give up your citizenship, and that's still the ability. You still have the ability to opt out in that way. And it's like, well, number one, if you do that, you still have to pay the exit tax, which again, they're still going to tax you on everything that you have. So it's not like you're actually getting out of paying any taxes. It's just opting out on future income and future wealth. Um, but number two is that you already have to have a citizenship somewhere else in order to be able to expatriate from the US. And the only way you can have another citizenship somewhere is either number one, you are a citizen by descent. So you just got, you won the genetic lottery and you've got parents who were, from Italy or something. And so you already have dual citizenship somewhere because you just, genetically, you lucked out there. Or you have to already be wealthy and you have to be able to purchase a citizenship somewhere through citizenship by investment programs, which can get very expensive. Like just purchasing citizenships in other places through donations to the governments can be, millions of dollars sometimes. And so it's something that opting out from the system is something that is not available to 90% of citizens. Um, so from a moral standpoint, I do think that it's very easy to argue that that paying all of your taxes it's an immoral relationship or arrangement. Now, on the practical side, I would absolutely never act on that in terms of like trying to get out of pay my taxes from in an illegal way because the risk is just not worth it. The reality of the situation is they do control a monopoly on violence and people die in prison from not paying their taxes. And I have much more to live for than trying to stand up against the man in that way. There are plenty of ways to legally reduce your taxes with deductions and credits by investing and living and doing business in certain ways. It's very, very difficult at high incomes to completely eliminate your taxes. And all the people who promise you differently are either ignorant or lying to you. Um, so I don't think it's worth it to try and say, well, it's wrong of them to tax me, so I'm just going to try to, you know, I'm just going to try and get away with doing something that they would imprison me for. Personally, I don't think that risk is worth taking at all. Um, but, but yeah, I don't know. That's my opinion on it. All right. I thought QE was only for emergencies like 2008 or COVID. That's why they're not calling it QE. That's why they're saying for reserve management purposes, we're going to be using the it's the SOMA. What is it? What does it stand for? SOMA. It's the man, let me look it up. Fed SOMA. System open market account. We're going to use the system open market account in order to purchase T-bills and short-term treasuries up to a certain maturity for reserve management purposes to make sure that reserves stay above ample levels. Um, so they're saying this is not QE, which is funny because it's like that was the joke that everybody said back in like 2019 when they're like, hey, we're adding to our balance sheet again, but it's not QE. It's like, well, okay, I don't care what you call it. You are creating money out of thin air to buy government bonds off the market to introduce liquidity. So, I mean, I don't even like the term quantitative easing. We should be calling it debt monetization because at the end of the day, you're taking government debt and monetizing it by exchanging that for newly created currency from the central bank. That's what debt monetization is. All right, next question. If what you were saying yesterday holds mostly true, it may be a good time to load up on VGLT. Pushing long-term yields down should push the ETF up, as I understand it. What is okay? So VGLT, is that a Vanguard long-term Treasury ETF? Okay, so that'd be something. This is probably very similar to TLT. Let me take a look, make sure. Yeah, it's probably very similar in composition. TLT is the 20-year plus Treasury bond ETF from iShares. VGLT looks like it's the exact same thing, just from Vanguard. So the explanation you gave in the question is correct. If long-term yields go down, then the price of those bonds goes up. The relationship between bond yields and bond prices is always inverse because if I borrow $100 from you at 10%, then I owe you $110 back, let's say in 1 year. Something happens and you want to get rid of that before 1 year and you want to sell that contract, that bond to somebody else, you can do so. So if somebody else then purchases that from you at the fair value, let's say a couple days after we establish that debt instrument between us, then they would pay you $100 and now I would owe that new person $110 back. And so you would have no gain or loss. But let's say something happens in between the time that we establish our agreement between each other and interest rates across the board for other forms of debt that are similar have moved down. Well, now if you wanted to go out and deploy a new $100 into a new loan, maybe you can only get 5%. But this is actually going to work out really great for you because if you want to sell the debt that the bond that you established with me, I'm going to pay you back $110 no matter what. It's the dollar amount that I owe you back. And so then you can go out into the marketplace and you can sell this bond to somebody else for $104 and something, whatever the math is. Because that new person will pay you, let's just say $105. And I'm going to owe that new person back $110. So they're going to get their 5%, which is what they would get from somebody else. But you were able to make, $5 just by establishing that debt when interest rates were 10% and then selling that debt when interest rates went down to 5% because the dollar amount that gets paid back on loans is always the same. Conversely, let's say interest rates had gone up in that time. Well, then if you want to sell that debt, you're going to have to sell it at a price where the new buyer of that debt will still be able to get the higher interest rate, let's say 20%. And so you're going to be able to maybe sell that for, $90. So you'd take a loss on that. You loaned out $100, but you only are able to sell it for $90 because interest rates went up. And so interest rates, yields, and bond prices are always inversely correlated because the dollar amount getting paid back stays the same, which means that the percentage that represents changes. Now, when you said it may be a good time to load up on VGLT, that's assuming that long-term interest rates do go down. My expectation over the next couple of years up to the next decade is that we're in a period of time where long-term interest rates are actually going to be moving higher due to the inflation that's going to be caused from all the government borrowing, spending, and debt monetization that's going to happen. So for the government, they'll be able to borrow at the short end at a rate that's lower than the rate of inflation, but that will push interest rates up for everybody else, and especially at the long end of the curve. So unless the Fed steps in and does yield curve control and kind of like an unlimited QE across the yield curve, and the Fed starts actually buying long-term treasuries, I don't see the free market stepping in to push those rates lower. The only caveat to that is if banks do it for the Fed, which is very possible. So your investment idea of loading up on long-term treasuries through something like an ETF, I think has an okay chance of working out, but also has an okay chance of going the wrong direction. Okay, I'm a sophomore in college and I just invested $1,000 into assorted mega cap. Oh, where'd it go? Okay, assorted mega cap stocks after hearing about the Fed. Going forward, should I continue to dollar cost average into the market to hedge inflation? Um, all right, Blake, it would depend. So if you're a sophomore in college, the questions that I would ask you to seriously consider are A, what is your income? B, what are your expenses? Because if you're in college, I would just roll the dice on the fact that you have borrowed money, which means that your expenses in total are more than your income. So in a situation like that, I would say it's probably not a good idea to invest. Um, I would focus 100% of all my efforts on increasing my income because at this point, you're in college, you're still new. Um, you don't have a high income, you don't have high income skills yet. And even once you graduate, it's going to probably, depending on your degree, it's probably going to be a ticket for an entry level job, which means that you're still at that point probably not going to have an extremely high income skill set. In other words, the ability to produce a high income for yourself. And I think that a high, not I think, the data shows a high income is the far and away the most powerful wealth building asset that you can have. And it will far outperform in terms of its wealth building effect. It will far outperform a couple extra years of dollar cost averaging into stocks and index funds. Because at this point, you're probably investing maybe a couple $1,000s per year. A couple $1,000s per year invested into even the best performing stocks in the S&P 500 over the next 10 years or so, at best, will be able to get you a total of like maybe $50,000 at the end of, let's say, a decade. How much, that'll turn into. However, a couple $1,000s a year is actually very, very powerful in terms of increasing your skills at producing income, whether that's money that you spend on trying to start little side hustles and businesses to make money and you get the experience, whether that's money you spend on courses or programs or events or coaching in order to, try and learn from other people who are ahead of you. Those skills will give you the ability to produce, $100,000, $200,000, $300,000 a year, or sometimes much, much more than that. which means that your ability to save and invest in a couple of years, like let's say in 5 years, your ability to save and invest 50 grand a year or 100 grand a year is going to be very doable if you focus almost exclusively on trying to increase your income. Um, and then at that point, once you're saving and investing tens of thousands of dollars per month, you're going to build wealth much faster than you ever would have if you would have just been, throwing a couple $100 a month into the S&P 500 when you were in college. So I know it's not really traditional, and maybe there's a middle ground that feels most comfortable to you there, but it's the bottom line is you're going to build far more wealth over your life if you focus in the beginning on increasing your income as quickly as possible, um, because even if it takes you longer, you're going to create a lot more wealth by investing 10 or 100 times more, than you will by starting investing a couple years earlier. Um, from Jambobski, how are U.S. stock markets going to look for foreign investors? Will we see a weakening dollar from here on out? I don't. I don't think we will see a weakening dollar from here on out. Obviously, there's some good volatility. I think there's a very good chance the dollar index itself gets back up into the above 100 range. Um, so it might take longer than I expected it to. Looked like it was headed there, and we kind of hit resistance and have fallen back off of that. But I don't expect a continuously weakening dollar for the foreseeable future. At worst, I would expect the dollar to kind of move sideways. They'll be volatile and ultimately move back up, but we'll see. Why do you have a point on your forehead? Are you Hindu? That's a zit, dude. Sorry, should have covered it up for you. All right. Inflation is an increase in the debt pile. It is man made. And taxes, if they were the same as borrowing, inflation would be zero. Inflation is an increase in the debt pile. Uh, I, I mean, sort of the increase in the debt borrows money into existence because money comes into existence through lending. That is how dollars are created. So it's different than like inflation of the past where they were like printing physical dollars. Today, when money is created, it's created through lending, which means that every new dollar of supply is a little more than one future dollar of demand because that dollar is, owed back at some point. Um, if taxes were the same as the borrowing, inflation would be zero. No, because they just spend the taxes back out. If you're saying the government running a surplus, but again, once they pay, if you continue that line of thinking, then eventually the debt would get paid back, and so that surplus would have to go somewhere. And so, unless you're just saying the government would just keep that surplus out of circulation and effectively destroy it, um, I think you're trying to hit on some MMT talking points there, and kind of maybe not really sure what you're uh, what you're talking about. Okay, next question. There's a $2,000 fee to renounce U.S. citizenship. Yeah, and the fee is going up, but honestly, that is almost nothing compared to what you'll have to pay in exit tax, and what you'll have to pay to actually establish a citizenship somewhere else if you didn't win the genetic lottery. Um, let's see. I believe you share the view that at this stage, there is no straightforward path back to a sustainable debt position, and the kicking the can will continue even if attempts to inflate the debt away. Um, when you say it depends on what you mean by sustainable debt position. So Back in 1945, we had 120% debt to GDP ratio, and by 1980, the debt to GDP ratio, government debt compared to the size of the economy, was down to 30%. So over those 40 years, they effectively went from an unsustainable debt load to a sustainable debt load. And that was accomplished a couple of ways. Number one, they inflated the debt away. So the money supply increased. The government borrowed at a rate less than the rate of inflation. They did that through the Federal Reserve doing yield curve control. There was financial repression so that you couldn't escape by buying gold. There's no Bitcoin. It was very difficult for the average person to buy stocks. Most people just saved. So the average citizen bore um, the financial burden and absorbed that cost through the loss of purchasing power over those 40 years. Um, and the reason why it didn't feel like a massive 40-year depression is because there was also a huge boom in productivity. Over those 40 years, we saw a very large spike in women entering the workforce. And also that started before 1940. It was like I believe it was like 1920-ish, or a little bit after when women started, when that growth curve kind of started, women entering the workforce. Obviously, it really accelerated during World War II, um, and so there was a big increase in the total workforce over those decades, which increases overall net productivity. If double the people are working, you're going to have double the things being produced. Um, the other thing during that time, if you're measuring just from like the end of World War II, is all the men came home. So it was like before that, that's a huge difference to go from, hey, all of the resources, all of the energy, all of the food, all the metal, all the oil, all the stuff we're making is going to actually like literally get destroyed, like going overseas to get blown up. And all the people are working towards that aim as well, to literally, like, not even figuratively, literally destroy resources. And then that ends, all those people come home and actually start working productively again. And all those resources get freed up for productive use again. It's like, obviously you're going to have a big boom from that point. And then there is, there's the regular economic growth and production and innovation and technology gains and all that as well. So there was a big increase in productive capacity over that time that allowed the economy to absorb the government deleveraging without feeling a ton of the financial pain. So it was like, without the government doing that, private individuals would have felt a lot wealthier. But with the government doing that, it was like, those forces, somewhat offset each other. So we're at a similar period in time right now where it's like, okay, well, the government is going to be trying to use some of the same tricks, trying to inflate the debt away, borrow at a rate lower than the rate of inflation, potentially institute some sort of financial repression controls to make sure that most of that gets laid on to the economy and people aren't able to escape it as easily. Otherwise, it won't be as effective. But you do need a big boom in productivity in order to offset that perceived feeling of, that financial cost. So, and that is always something that is possible, in terms of like big increases in productivity. So things like energy getting a lot cheaper will definitely help, because energy is one of the biggest inputs to everything in terms of the creation of it, the raw materials, the transportation. Um, AI and robotics can absolutely be something that could help with that going forward for the next years and decades. And so big increases in productivity can help offset that. So instead of life getting just better and cheaper and more wealth and more abundance from all that, it just offsets the cost of paying for the government to deleverage. He skipping my questions. I'm sorry. I'm trying to get them all, but they're coming in faster than I can see. So I apologize for that. Whoa, geez. Hoffy 11, thank you for the super chat. $50. That's crazy. Thank you. Um, been following some of your video for a while and just wanted your opinion. I've got a little crypto. I've got some metals in my mind. The next thing for me is to try to rotate into some real estate. Would love your thoughts. Okay, I'll talk about the crypto first. I think if you've been following me for a while, then you know I don't like crypto. I do like Bitcoin, but I don't like anything else. And so, if I can, the only way I can answer this question is to tell you what I would do in your situation. So the first thing I would do if I just landed in your shoes and had the portfolio that you just described is I would immediately get rid of everything that all my crypto that is not Bitcoin and replace it with Bitcoin up to a 5% allocation because at this price, Bitcoin is still an asymmetric bet. 5% gives you plenty of upside for your portfolio if Bitcoin becomes money and very little downside if it ends up going to zero because for whatever reason, people don't want to use it in the future. In terms of metals, silver, when you say metals, I'm assuming that it's mostly gold, but probably some other metals mixed in. Gold, I view as my savings account. Other metals are for other parts of my portfolio, whether it's commodities or trading. Um, and so gold, I usually try and keep about 20% in gold because it maintains its purchasing power over time. That way, if assets go on sale, I have some dry powder to buy those assets. I have some dry powder to be able to use for other things if I need to. Over the long term, it maintains its purchasing power. If you look at the price of stocks right now in gold, they're not terribly overpriced. In fact, they're very, very normal, historically speaking. Same thing with real estate. And so, if you're holding dollars for your savings account, it can look like, man, I don't want to buy these things because they're super expensive. If you hold gold for your savings account, it's like they're not super expensive historically right now. So it operates like real purchasing power and like a real savings account over the long term. Um, I also keep about 5% in cash and cash equivalents, about 30% in stocks, and about 30% in cash flowing single family real estate. I like single family homes because you don't have you stick in the areas that are not as affected by big booms in multifamily. You stick in the areas that are landlord friendly because you have to, the rule is single family. My rule is single family and cash flowing. So it keeps you in areas that are landlord friendly because if you're trying to buy a rental property in like Huntington Beach, you're not going to be able to buy that today and rent it out and cash flow. um, and so it keeps you in, those two limitations keep you in areas where they're landlord friendly and keeps you out of areas that have, for the most part, the potential for big decreases in price from big explosions in multifamily housing. Multifamily is also a lot more boom and bust. It also is a lot more concentrated in areas that are more cyclical and prone to boom and bust. Um, it also you have somebody who is increasing your equity for you. I like 30-year fixed rate mortgages on them. Right now putting down anything between 20 to 30% to make sure that they are cash flowing and then you take the tax benefits from that. So personally, that's the portfolio allocation that I do. If you don't have like a large enough portfolio for a allocation like that, that's perfectly fine. It's no issue at all. You just start working on it piece by piece. And so let's say you've got the Bitcoin piece and the gold piece right now. Next piece you start working on is building, let's say the real estate piece. That's completely fine. And then once you get that, now you start building up the stock portfolio, building that up. And so if you don't have a large enough portfolio to just say, okay, I'm going to do all this right now, maybe because you're younger or your income is still not where you'd like it to be, or you just waited too long or whatever. That's completely fine. You can just piecemeal in, and you don't have to establish it all at once. There's always an opportunity. This is the one thing that people always get allows people to get into trouble the most is people think if I don't do this now, there's never going to be an opportunity like this again in the future. And that's just not true. As long as humans are alive, there's going to be an opportunity to make money in the markets, both on the long side and the downside. And so that fear of thinking like, if I don't get in right now, I never will. If I don't buy this right now, it's going to run away from me. This is the best opportunity that's ever going to exist. Those are things that cause you to make bad investment decisions that end up losing you money. So there's no urgency ever. All right, next question. Um, when will the yield curve become a serious concern, and how does that math with U.S. gold reserves given the pace of increasing price de-dollarization? Well, the yield curve kind of becomes a concern um, when it gets to the point where it's like unmanageable, like super, like incredibly steep. So, like for example, like right now, the U.S. government is not doing a lot of borrowing at the long end of the curve. One reason for that is because there's not a lot of demand for 20 and 30-year treasuries, and so when they do those auctions, they don't usually go super well. There's just not a lot of demand. No, there's not a lot of lenders wanting to lend there. And so if the government tries to issue a bunch of debt at the long end there at 4%, um, they're going to be pushing those rates higher because when the government borrows anything, that's the same thing as that new thing being sold. And so that pushes the price down, pushes yields and rates up. And so they're not doing a lot of borrowing there. Most of their borrowing they're doing at the short end of the curve. They're borrowing with T bills, and it to the point where like this year alone, there's like I don't know, it's 20 or maybe closer to. I don't remember the math, but it's like I think closer to 30% of the entire national debt is maturing this year, and that just gets worse every year because all the long term debt that matures, a lot of that they're rolling that over into short term like T bills. And so it's getting to the point where the average weighted maturity of the overall national debt is just getting shorter and shorter and shorter. If this continues, then all of the debt is just 1 year debt. It's constantly maturing and getting rolled over. One of the reasons why they're doing that is because there is a lot of demand for short term because it eliminates a lot of pricing like inflation risk for the lenders. And also you've got a lot of borrowing, a lot of demand for that at the short end, especially because that's a lot of what the Fed is buying right now. Um, the ultimate plan, it seems like through Scott Bessent, Trump, the new people going in at the Fed, and whoever the next um, chair of the Fed is, seems like they're going to try and do some sort of longer term refinancing of the government debt, whether that's a coordination between the Fed and the Treasury, where the Fed says, hey, we'll buy up to a certain amount of 10, 20, 30-year treasuries, and that allows the US government to take everything that's at the short end and roll that over into longer term debt at let's say 3% and lock that in for the next couple of decades. I would not be surprised to see something like that happen. I don't know if that answers your question, but I think something like that is definitely possible. Um, all right, next question. Okay, I'm trying to find that question from you, Supanoodle. I can't find it because somebody else said that I should answer it too. Supanoodle. Can I click on your name to see everything? No. I could put you in timeout. I didn't know that was a thing. I don't know what that means. Um, Supanoodle. I don't see your question actually. I'm scrolling up. I don't see your name popping up again. If you're still on the live, put your question in again. Oh, there it is. Okay. Do you think it makes sense for a somewhat investing knowledgeable person to trade and or stock pick to try outperforming dollar cost averaging index ETFs and some golden bonds? I mean, I think 1,000,000%. That is most of what I talk about is like at the bottom level of like wealth and investing and finance knowledge. It's like those those people are just like I get money, I spend it, and I also borrow money and I spend it. It's like financially speaking, that's the worst thing that anybody can do. Then the next step up from there is like just standard budgeting, and I save a little bit more than I spend, and it goes into a savings account. It's like those people are you're going to be better off. Still not ideal, but you're going to be better off than the person who just, consumes more than they produce always. Next level up from there is I'm going to start investing. And it's the person who's going to, go hire a financial advisor at 2% a year because they don't know anything about what a stock means or anything like that. Um, and at least they're going to be doing better than like a savings account. Um, so that's the next level up from there. The next level up from there would be I'm going to invest the same way that financial advisor would. I'm just going to do it myself. And, that's buying some index funds. And in that case, over the course of your, 20, 30, 40 years of investing, you're going to do way better than them, even if you just do the same thing, because you're not losing 2% a year to fees. And over a compounding interest over 20, 30, 40 years, that adds up to potentially literally millions of dollars difference just by investing the same way without that, 2% management fee. Then the next level up from there is like where you get into, okay, this could drop you back down to the bottom, or you could actually be leveling up from here. And that's actually trying to actively invest yourself and choose specific targeted like ETFs for different sectors, choose individual stocks, allocate across different asset classes. And the reason why I say it could drop you down and give you the same results as somebody on like a lower level is that you could just do it wrong and badly, and you can lose a bunch of money, especially if you are being emotional about it and you're buying things at the high, selling things at the low, and chasing fear and greed and just doing all of the wrong things. Then instead of making the average market returns, you're going to do way worse than the average market returns. The thing is, though, if you approach it as, hey, this is maybe a part-time job of mine, and I'm gonna have, if you approach it with this like the learning mindset of it's going to be an expensive thing to learn over the next couple of years, and you say, okay, for the next 5 years, I'm expecting that I will not do well, and I'm going to learn my lessons, and I'm going to keep on improving. I think that's a really great way to approach it because you will make mistakes. You're going to be buying things and selling things based off of um, incorrect decision making frameworks. Um, and so and so instead of looking at that and throwing in the towel and saying, okay, I'm just going to give it back to the financial advisor or go back into index funds, you look at that and say, okay, well, what did I do wrong and how can I avoid that in the future? And just because you lose money doesn't mean you made the wrong decision, by the way. Losing money on an investment is not a sufficient metric of decision making success. You have to look at the information you had at the time that you made the decision, say, okay, did I make a good decision given the information that I had? And sometimes that does result in a loss. And that's why most of the time it always comes down to performance over the long term comes down mostly to risk management. Every single one of the best investors and traders throughout history manages their risk, and they say that's the number one rule. Whether it's somebody like Warren Buffett who says rule number one is never lose money, rule number two is never forget rule number one. Whether it's oh man, I can't remember his name, who he said uh rule number one, cut your losses short, rule number two, cut your losses short, rule number three, cut your losses short, and then you might be successful. There's another famous trader who says I can't remember them off the top of my head, but there's a million different ways to say the exact same thing, which is cut your losses short, manage your risk, make sure no matter what, you never open yourself up to large losses, take care of your losses, and your profits will take care of you. The losses are the most important thing to focus on in terms of not letting them happen. And you can do that a number of ways. You can do that by value investing with margin of safety. You can use stop losses on trading. You can do options to hedge. You can do position sizing to make sure that even if it goes to zero, it's only 1% of your portfolio. There's tons of different ways to manage your risk effectively. But you have to manage your risk in some way. Otherwise, you open yourself to blow up. And so 99 times out of 100, if that's the thing that you focus on more than anything, then over the long term, you'll be able to figure out a way to be successful. For your long-term investments, you said you protect with puts. Doesn't this eat away at your profits? Yes, there's no free lunch. There's no way to either if you want to protect yourself, let's say you own a stock and you want to protect yourself from losing money on it. You can either guarantee execution of getting out of that stock by doing a stop market order, Or you can guarantee a price by doing a stop limit order, but then you don't guarantee execution, which means you might actually get stuck in it. Or you can guarantee price and execution by buying a put, but then it's not free. You have to pay for it. And in paying for it, you lock in a temporary or a permanent uh, small loss on that because you have to pay for it. And now you need a higher return on the stock in order to pay for that protection that you purchased. So some people will do like collar positions where you buy a long-term put in order to get the best bang for your buck in terms of time value, and then you sell, like 30-day calls on the stock for 6 months or so until you've paid for it. And then, assuming you still have the position, now you've got a free protection on it because you paid for it, so you stop selling the calls, so you have unlimited upside. So there are different ways to try and manage it, but at the end of the day, there's no such thing as a free lunch. You can guarantee execution, you can guarantee price, you can't guarantee both for free. You can guarantee both if you pay for it, but then you're locking in a partial loss. And so the over time, you have to learn appropriate hedging. You can't just constantly hedge, which is why if you look at the ETFs that do constant hedging, like they're called hedged equity funds, they always drastically outperform the underlying. I'm sorry, underperform the underlying. um, because they're just bleeding so much to just constantly having that protection in place. So if you're only hedging when, the greed is at extremes, when the market is extremely overbought, based on technical factors, based on value, whatever, like you can establish some metrics that you use to dynamically hedge when it seems appropriate. Then a lot of times, once you learn how to do that, again, this is an expensive process, so you won't be able to do it day one. You can learn how to hedge more effectively. It's just you're not always hedged. Hmm. All right, let's see. Next question. Um, how do you buy or sell your gold without paying too much of a premium? Um, well, one thing is for my long-term gold holdings, I don't sell. Um, for the most part, I don't, unless it gets to the point where I'm like way overexposed because in terms of my allocation, because um gold has gone way up and let's say stocks have gone way down, which so far hasn't happened yet. And also, if you're not able to rebalance through new contributions, like in certain cases like that, it's like, okay, well, I can rebalance by just taking more of my income, my active income, and applying that into stocks, and that brings my allocation back up to normal. You don't have to rebalance through selling, um, a lot of times. But for the most part, through buying, one way that I like to do it is use the services that are uh, like automated purchasing plans. Some of the ones that I've talked about are One Gold, Vaulted. I think Silver Bullion Singapore has one of these plans. Monetary Metals has one of these plans where you can just constantly be buying, and then you don't have physical ownership. Or no, I'm sorry, you have ownership of it, but you don't have physical delivery of it immediately because you're going to get killed on those fees if you're taking delivery of like a tenth of an ounce or even 1 ounce at a time. So then once you get your stack up to something significant, 5 to 10 ounces, then it's like, okay, now I'm going to take delivery because my cost per ounce of taking delivery on a large amount is very small compared to cost per ounce of taking delivery on a small amount. And so you can dollar cost average in, build up your stack. Once you get a big enough stack, then get physical delivery. I personally, just because of my life situation, I think it's not safe for me to own physical gold, like on my person, on my property. It's just too easy these days to find out where people live. Like that is fake. That's plastic. I don't have any gold, and I do have a lot of lead. Next question. Have you looked into a family office as a CEO of your family office? Do you or will you use universal life insurance and create a family bank? At this point, no. That might change in the future. The one reason why that I think could change would be for the asset protection side, just because there's different rules on things that are considered life insurance versus things that are considered assets. So that could be a big decision-making factor in that. But in terms of the whole banking thing, like the whole life policies with the infinite banking and like those are strategies that can be used outside of insurance. They're not like inherently tied to insurance. Um, in terms of family offices, um, yeah, maybe. Not yet though. Why gold over silver? Gold to silver ratio is at an all-time high. Silver is also consumed more than gold is, harder to recycle. Well, because silver is not a monetary asset, gold is. And what I mean by that is nobody in the world outside of a couple retail investors, and by a couple I mean relative to the global population, nobody uses silver as money. But v- most of gold that exists is used as money, or it's used as a store of value. It's used, as a, you know, as an international monetary asset. Most gold is stored in central banks and in sovereign wealth funds. Um, and silver's role as money has been declining in terms of its monetary usefulness since the invention of paper money, because silver existed as money so that you could make change for gold, because gold per ounce very valuable. Silver was change for gold because maybe an ounce of gold is too large of a denomination for a small purchase. Silver's less valuable, so it was used as change for gold. Through a lot of human history, the ratio value of gold to silver was held by law. And so through most of history, you'd either have gold driven out of circulation or silver driven out of circulation, because people knew, oh, by law, this is actually, undervalued. So it's really, really more valuable than they say it is. So it gets driven out of circulation because people hoard it. So you can't look at the historical gold to silver ratio as anything meaningful because it was held by law. And as soon as those ratios were freed up, you saw an explosion in the gold to silver ratio. Um, when paper came around and people started storing their gold and using paper in order to exchange the ownership of that gold as money instead of moving physically the gold itself, the usefulness of silver started to decline, because you can have gold be infinitely divisible now. You can write any amount on a piece of paper and exchange that amount because it's redeemable for that amount of gold. You can say this piece of paper is worth 1/1 millionth of an ounce of gold, and so in order to go redeem that for gold, maybe you need 1 million of those papers to go redeem it for an ounce of gold. Um, and so the value of silver in terms of its monetary usefulness started to decline about 300 years ago. Um, that doesn't mean it doesn't have value today, because it has a lot of industrial value, but that's most of where its value comes from today. And so the supply and demand for silver versus the supply and the demand for gold has no inherent relationship that must be anything. So there's no like by physics, or there's no like economic law or anything like that that states that the ratio of value between those two metals must be anything. And so it is entirely possible that the gold to silver ratio continues to increase for all of human future from here, because for whatever reason the value of gold continues to increase and the value of silver continues to decrease relative to each other. Now, that being said, I am bullish on silver. I just don't think it's going to do what a lot of people think it's going to do, especially because the reasons that people think it's going to do that are logically invalid. But all that being said, yeah, I'm bullish on silver. It's just not a savings account. Look at what silver has done for the past 100 years. Look at what gold has done for the past 100 years. Gold has maintained its purchasing power. Silver has not. All right. Let's see. Um, Appreciate it if you manage to get this as a follow-up, buy out a fixer-upper or get a loan 20% down, rent out ASAP. Also, thoughts on property management services. Um, Personally, I've never done a fix and flip, so I'm not talking from experience here. But I do know quite a few people who have been in that business, some of them very successful, some of them not. And it is a job. So if you don't have a full time job, or maybe you have a part time job and you really know the area, or you know somebody who is very experienced in this, then that's a great thing to be able to get into. Um, it is a difficult thing to do, especially as a new person, if you don't know anybody who's helping you. There's just and there's a lot of risk involved with that too. It's not like something where if it just doesn't work out, it's like, "Oh, well." You're on the hook. So, if you do know somebody or you do already have experience doing that, then, then sure, by all means. For the typical person who's like, "Okay, this is just something going into my investment portfolio, it's not gonna be a job for me," then, the way I do it is, yeah, 20 to 30% down, and I do it in other states where the rental market is perfect, where they're landlord friendly, where you can still cash flow, and I never see the properties. So I've got a property manager who, does it all. The most interaction I have about my properties is like, "Hey, like, you know, tenant moved out. Here are the things that we think should be fixed. What do you want to fix?" I say, "Okay, yeah, do those." Um, so that's the way I do because my investment portfolio, I don't want it to be I don't want it to be something that costs a lot of my time, or more of it than necessary. I don't want it to be a job, if that makes sense. All right, next question. Okay. What do you think about the Japanese yen? Their wages seem very low compared to the productivity. Um, I think the yen will continue, and the Japanese government bond yields will continue going the direction that they're going. Um, the They've got a lot of problems that have been baked in for a long time. All right, let's see. Huge fan, longtime viewer here. Thank you. I appreciate it. One should probably be handy and have time if one wants to flip. One of the one of my friends who is very successful flipping, um, was doing most of the stuff, and obviously he was hiring a bunch of contractors and stuff too, but he was still actively involved in like everything. And one morning it was like, kind of like a fire came up at one of the properties. Somebody didn't show up. He needed to get something done. So, it was like 4 a.m. He didn't get a lot of sleep the night before. And he's very handy. He's done a lot of these at this point, and he's over there and he's, can't remember what kind of saw he was using, but he was cutting a 2 by 4, and just because he was tired, wasn't paying attention, and just went vroom, just cut his pinky right off. And so so yeah, that's one of the examples that I use of even if you are handy, it's like, A, it's going to be a job for you, which almost is like, If you're able to not be handy and get into it and you just have to figure out how to be profitable by hiring everything, then you're treating it as a business from the start, and it can be easier to remove yourself from it, because you're not constantly saying, okay, well, why am I paying this person $30 an hour to do something that I can do for free, which keeps yourself in the business as the bottleneck. But again, that's if you're trying to build a business out of it, which is fine because you can be very successful, make a lot of money that way. But that is different um, than building a portfolio of that's part of your overall portfolio investing allocation. All right, next question. What's the difference between fiat money and paper gold, considering that the paper gold market is inflated by 100 to 200 times? Well, for one, is that you can actually get real gold. So the difference is that like fiat money is just like it's fiat money. It's not like it's not like there's a bunch of fake dollars floating around out there and then there's some real dollars. It's like dollars are dollars and the supply is continuing to increase. Versus gold, it's like there are increasing claims on some gold, but that doesn't prevent you from getting physical gold yourself that nobody else has a legal claim on. And then whatever happens with those other legal claims, if and when that blows up, doesn't impact you, or if it does, it just makes the price go up. Are you interested in running for office? I represent the International Logic Party, and our tech makes real democracy possible in the US. It also makes people smarter. We need a candidate. I can't tell if that's a joke or not, the International Logic Party, because if that's a real thing, then if there was ever a party based in logic, it would never it would never get any power at all. But no, if that is a serious question, I am not interested. I've never been interested, and I don't think I ever will be interested in running for office. I think that people in positions of power as individuals, at least in places like the United States, have little to zero ability to do any real good, make any real changes. You kind of have to become a part of the machine in order to even get inside the machine. And then once you're a part of the machine, you can't really change the machine. And we've kind of seen that time and time again with really big promises on the campaign trail just fizzle out into just status quo once they get into power. And part of that is because a lot of people think, okay, well, um, the problem isn't the power existing itself. The power is the power. The problem is the power is being used in the wrong way. So if I can get into power, I can use it in the right way. And the issue with that is you're going to last what, 4 years, 8 years. And so then somebody else who has different ideas is going to wield that power in their own direction. And so for whatever reason, the things that it takes to get into positions of power blocks somebody's mental faculties from realizing, hey, the solution is to actually destroy the power. Because once people get that power, they don't want to take it away from themselves voluntarily, even if that means removing it from people in the future for whatever reason. So, all right. Let's see. Next question. Is buying stocks like Realty Income and VICI a good way to add real estate exposure? Yes. So I'm not saying yes to those two stocks specifically. There are plenty of real estate stocks that are decent in order to establish a real estate portion of your portfolio. However, the way that I would do that is treat it as a temporary position until I'm able to have enough for a down payment for a real property. And the reason why is because if you buy a REIT or a real estate ETF or a real estate stock, number one, there's zero tax benefits to that. Physical real estate, there's like more tax benefits than pretty much anything to that. Number two, you buy a real estate stock, there's no leverage advantages to that. You can't take out a 20-year, 30-year mortgage on a stock, a fixed rate mortgage on a stock, but you can with real estate. In fact, most of the gains that have happened in real estate over the last 100 years have come from the ability to use cheap leverage on it. so your cash on cash return is high, even though the real estate itself has had just very unimpressive returns on average. The third thing is that you with physical real estate, you have somebody in there who's building the equity for you by paying for your debt service cost. And so if you buy a stock, it's like you would need a dividend on that in order to pay for your margin loan if you were going to try and replicate that. And it's just the rates just don't work out that way. And plus they're not fixed. So there are huge advantages to actual physical real estate that you can't get with large with real estate stocks. Also, the fact that in public markets, because there's such large amounts of money being deployed, valuations get pushed up. Where you can get a lot better cash on cash returns by buying physical real estate. Like Warren Buffett is not going in and buying up, the $120,000 house in Georgia, because it's like he's got $300 billion to deploy. That's not going to move the needle for him. Even if the return is great on paper for, the percentage return, he's got $300 billion to deploy. So that's not going to move the needle for him. He's looking for something where he can deploy 50 billion at a time. All right, next question. Democracy is code for communism, kinda. There's a quote, I can't remember who said it, but basically democracy will last until the people realize they can vote for themselves from the public treasury, um, or vote for themselves largesse from the public treasury. Basically, wield the tyranny of the majority. Democracy is tyranny of the majority. Um, it's two wolves and one sheep voting on what to have for dinner. Um, so that's why people say things like that. All right, let's see. Next question. Do you think there's a possibility to go back to the gold standard with gold at 10 to 15,000 could have some practical substance to remain being the reserve? I know difficult but interesting to explore. I mean, it won't happen voluntarily. Throughout history, anytime a nation has moved from a fiat currency back to gold, it's because the fiat currency has failed. Um, because at the end of the day, like honestly, this is like imagine we lived in a world where let's just say, just imagine hypothetically, we have people who are in the government and at the Federal Reserve who are managing finances somewhat reasonably. Like deficits are small, the money supply is not being expanded, no QE, interest rates are somewhat free floating. Um, there's, they allow the a boom and bust cycle to take place, for, recessions. They're not constantly trying to bail out and subsidize failure. Um, like reasonable, maybe not ideal, but just like reasonable monetary and fiscal policy. In a world like that, 99% of people would not care at all. Like, be like, okay, well, yeah, maybe the inflation rate is, a 0.5% a year. Doesn't bother me at all. Maybe, sometimes maybe there's a little bit of deflation. It's like, great, my cost of living got cheaper this year. It's like, perfect. Like everybody would be 100% okay with using dollars. Because nobody would be abusing it. Nobody would be stealing our purchasing power through the money printer. And so when you push that to the other extreme and the central bank and the central government, and they start just abusing it like crazy and just sucking wealth away from people, eventually people wake up and they're like, hey, we want an alternative. And we're going to get the alternative one way or the other. And then the people start using a different form of money. And then that means that the government doesn't have any purchasing power unless they get that new form of money that people have chosen. So that's what causes fiat currencies to fail and be replaced by something like gold, is mismanagement to the point of the people just choosing to use a different money. Um, if that were to happen, hmm, I think that in today's dollars, the value of gold would probably be much higher than 15,000, but I think we have a long way to go before we get there, especially because the way that money is printed today is through debt, which creates future demand for those dollars. So you constantly have a larger and larger deflationary bomb in the future from that debt. So yeah, I think if that is to happen, it's going to take a lot longer than most people think, and the government will not just voluntarily say like, oh, we're going to revalue gold higher. It's like, well, gold is freely floating right now. And so the real value of gold right now is 4,000, whatever, 4,100, 4,000, oh, $4,279 per ounce. Um, so just declaring that the value of gold is higher is like, it's not, it's just going to be that would just be an excuse to print. I've seen a lot of real estate signs that say Berkshire Hathaway. Yeah, it's a broker. They're not going around and like establishing a large portfolio of single family homes. They've got a real estate brokerage business. But my point was like similar. Like if you want to take it even one step farther than that, Berkshire Hathaway is not going around buying up or collecting free things from Facebook Marketplace and from garage sales and then flipping them on eBay. Even though the return on that per item might be 1,000% or even 10,000%, or infinite if you get something for free. Um, they're not doing that because it doesn't matter because the total dollar amount they're going to make on that is a couple $100 per item, maybe. So it doesn't move the needle for them. That's in a lot of ways, small investors have advantages over larger investors because those large returns can move the needle for you because you're starting off that, with a smaller portfolio. The gold standard has never worked because of Gresham's law. I don't think you understand what Gresham's law is then, because number one, the gold standard existed for all of human history. So I don't know what you mean by it never worked. Um, it gold has been money for as far back as we can go. Gresham's law states that bad money drives out good money, which means that if a government comes in and forces people to use a different form of money and declares the value to be different than what it really is, then that will drive the money that has true higher value out of circulation because people just hoard it, and they'll get rid of the government enforced money and through spending. And so it's the same reason today why people store gold and store Bitcoin and they spend dollars. That's what Gresham's law is. But that doesn't mean it's not work. In fact, it still works the same way. It preserves its purchasing power. Um, but yeah, Robert, what Robert said there is because of portability and divisibility of gold. That's the reason why gold started the why gold tends towards centralization in the hands of banks and storage companies is because if you want to buy something from far away or buy something with a large purchase price, or even buy something with a small purchase price, it is much easier to just transfer the ownership of that gold to somebody else rather than moving the physical gold itself. So that's the reason why paper was invented. So you could leave the gold in one place and then just change the ownership of it. And that way you're virtually spending gold because you're just changing who owns that gold. And that works really, really well. In fact, that's how gold mostly is done today. The gold stays in the vaults and the central banks buy and sell it from each other. And the gold, a lot of times, doesn't actually move physically. Um, but that's why it tended towards centralization. And then once it's centralized, somebody with a monopoly on violence comes in and just says, "It's mine now." All right. Um, I think I came in on the tail end of your answer, but I wanted to ask you if you think gold will go sideways for a decade now, but once you get some money anyway for diversity, just buy some anyway. If it was me and I was just all cash right now and I was coming in fresh and I was like, all right, how am I going to allocate my portfolio? I would still allocate it the way that I always talk about, roughly 20% in gold, 5% in Bitcoin, 5% in cash and cash equivalents, 30% in stocks, and 30% in real estate, and then 10% for speculation and hedging. Um, and that Number one, with the since you're asking specifically about gold, it preserves its purchasing power. And so if you look at gold, at in August of 2020, it's like, yeah, it moved sideways for a couple of years. If you look at gold in let's see, what was that? July of 2013, it's like, yeah, it moved sideways for a couple of years. But if you're dollar cost averaging because you're still investing and so you're still going to be building up that stack, then you're going to be able to lower your cost over time, even if it has topped out from here. Um, and so it can be painful to initiate your investment at the top of a run. But the alternative is, like, we don't have a crystal ball, and so I definitely am not making the claim that I think gold is going to just move sideways or go down for the next decade or 10 years. But in terms of these short term movements that are a couple years at a time, it's like gold tends to front run monetary policy, and it's gone up 100% or more in the last like year and a half. And now the monetary policy is moving the direction that gold was signaling it would. So I think that a lot of the move has probably happened, but over the long term, it still protects your purchasing power. And so if I were starting fresh, I would still allocate. And maybe if I was really hesitant to do that and it would cause me to not be able to sleep at night, then I would just say, okay, I'm gonna take the amount of money I'm gonna buy gold with, I'm gonna spread it out over the next 6 months and just and buy over the next 6 months if I was afraid of it dropping from here. Since the dollar is used all throughout the world, would they still use it if the dollar collapsed? No, I mean, it's the same currency, it's fungible. So dollars that are in circulation in uh, Lebanon are the same as the dollars in circulation in Alaska and Singapore and Arkansas. They're all the same dollars. Um, we just don't have visibility into how many of them there are and how much debt there is that's denominated in dollars. Because let's say, some country or some company in Zanzibar, maybe that's not a country. Is Zanzibar? I think might be a city in Tanzania or um, Poland or Switzerland. Some company is like, hey, we want to borrow money, and the person that they're going to borrow money from has a bunch of dollars because that person has sold things to somebody who had dollars. Well, now that company that borrows dollars, when they borrow that money, now they owe dollars back. And so because this is just private, a lot of it is private transactions, or even if they're, government transactions, they're maybe have visibility by their own central bank, but there's no global registry of all dollars. Because again, dollars are lent into existence. So if their dollars make their way into a bank account in Europe or in Asia, and then somebody borrows dollars, that bank has its own rules on how many dollars it can lend out versus how many dollars it has in reserves. And so the deposits at the bank still show that they can get those dollars back at any time, but most of them have been lent out. And that circulates around the entire globe that way. So most dollars that are in circulation are loaned into existence, and we have no idea at all what the amount is on either side, the total dollars or the total debt. Um, so yes, the answer is if the dollar system collapses and dollars become worthless and people stop using dollars, that happens everywhere to all dollars. Why do you only like Bitcoin? Solana, Ethereum, both these altcoins arguably have more use cases. No, they don't. Solana and Ethereum have zero real world use cases. There's no advantage at all compared to non crypto alternatives. There's nothing, no technology, no no real world use case that has demonstrated to be cheaper and more effective by using any cryptocurrency or any blockchain type technology rather than just using a non blockchain alternative. Um, and that I could be wrong about my opinion that that will always be the case. But we've had quite a bit of time now where there's been a lot of incentive and a lot of money poured into that. And the fact is that blockchain is a monetary technology, and it is something that evolved from many, 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 many different attempts at doing so. And Bitcoin is the one that ended up having the right mix of ingredients that organically evolved to become to grow into the thing that people ended up choosing and wanting the most. And when you try and shoehorn that kind of technology that is so simplified into serving one specific purpose, you try and shoehorn that into being used for something else. It's like, yeah, you could use paper dollar bills as toilet paper, but that doesn't mean that that is better than the alternative of using actual toilet paper. Okay, next question here. Why does the gold price have to be pushed down in order to create inflation? It doesn't. When inflation happens, or usually before inflation happens, gold goes up in anticipation of that. I guess worked is a subjective term. The gold standard worked to restrict growth. Um, Gold served as money in the best way possible for the longest period of time because it was the best vehicle to serve growth. Once the world got to a point where we needed smaller transactions and larger transactions and quicker transactions and farther transactions, then we needed a way to do that. And so that's why the invention of paper in order to transfer the ownership of gold happened. Um, but gold being used as money before that was used because it was the best option available for the world at the time. If gold were to be used as money today, it would be the ownership of gold. Gold would stay in vaults, and people would digitally transfer the ownership of gold to each other by swiping cards and paying with Apple Pay and sending, grams of gold over Zelle and the Cash App, and the gold would stay in the vault, but your ownership of that gold would change hands. Um, and so it'd be the exact same thing as paper, 300 years ago. It would just be digital today. Um, and so there's nothing inherently about that system that is restrictive to growth. In fact, the soundness of money, as long as there's no fraud taking place, um, means that it serves growth better than like fiat currency does, because fiat currency sucks away growth and causes misallocation of resources and therefore destruction of wealth. All right. So are you saying that we're about to go into inflation again? By the way, when I get quiet there, I'm trying to look through, because in the chat, obviously, I know you guys are talking to each other as well. So I'm trying to look through to find questions for me. It would actually be helpful. Maybe I'll have to probably say this multiple times over the next couple lives. If you have a question you'd like me to answer, like tag me, like put my name in it, say put at Heresy Financial. That way I can see it's directed at me instead of directed at somebody else. Um, So are you saying that we're about to go into inflation again? I think so, because of the QE, the lower interest rates, the spending, the borrowing. Um, I think over the next years and decades, we're entering into a period of time with rising inflation, and higher interest rates, just like we had from the 40s through the 80s, the last time the government was trying to deleverage. What is economic growth if not the increase in prices, which is more debt? Great question. I'm really glad you said that. This will be the last question because we've been going for an hour and a half now. Um, all right. So real economic growth is getting more for less. So like forget about the dollar price of things for a moment, and we're going to talk about like real world, like how stuff, how we get stuff. When you think about how you get clothes, how you get shelter, how you get food, how you get water, how you get conveniences like, plumbing, um, and air conditioning and things like that. You have to produce stuff or give somebody else your products, your time, your labor. And in exchange, you get those things. Now, obviously, in this kind of mental example, we're removing money as the middleman between that. But in reality, we give somebody something else that we are okay giving up because what we're getting in return, we want more than what we're giving up. So some of you may not ever work more than 40 hours a week. When I had a job, I rarely worked, when I was a stockbroker, rarely worked over 40 hours a week because that was enough to pay the bills. And I valued being with my family more than having that little bit of extra money, in my paycheck. So we give up something, time or labor or a product or a service. And in return, we get something we want more, which is, luxury, entertainment, food, shelter. When you think about like 500 years ago, 1,000 years ago, 5,000 years ago, you would, from sun up to sundown, be laboring intensely in order to hopefully, maybe get enough food and shelter to survive. And that was your whole life. And sometimes it wouldn't work out and you weren't able to get enough of that food and shelter and you died. And that was all of life. And slowly but surely, humans have figured out ways to get more for less. And so I use the example of fire a lot. Obviously, like this is, way back. But if you think about, okay, before fire, you'd have to eat raw vegetables and raw meat. You get sick from that probably quite a bit. If you eat something that's infected or dirty, you don't get a lot of nutrients from it. And so you have to spend a lot more time and you get a lot less out of it. But once we discover fire, we can stay warm from it. So we don't have to eat as much to get our warmth from calories. We can cook our food, which means we get a lot more nutrients that are a lot more absorbable out of our food by cooking it. Whether it's meat or vegetables, fruit, you can absorb a lot more nutrients when the food is cooked. You also eliminate, it's more sanitary. You eliminate the potential or reduce the potential of getting sick from it a lot. So that invention, that innovation allowed us to get more for less. In other words, same input or maybe even less input in terms of our time and labor, and we get way more out of it. And then the same thing happened when we realized, hey, instead of going out and finding animals and plants through hunting and foraging, we can bring those to ourselves and raise them here inside of a fence. And we call it farming. And we get a lot more for less. For the same input of our time and our labor, we get a lot more out of it. A lot more food, and to the point where few people are able to produce so much that there's an excess they're able to share with other people in exchange for something else that they want. So now I spend less time having to build my shelter because I can spend my time doing this farming instead, and I have a lot more abundance as a result of that labor, the way I'm able to spend my labor. And that's all of human history. We innovate, we progress, we discover new technologies, we implement the new technologies. Steam engines and coal and oil and tractors and information in the internet. All of these things are ways that humanity has discovered to get more for less. We have a lot more abundance available to us at a much lower cost in terms of our labor and our time. To the point where today, if you want to live the standard, the cost of or the quality of life that people lived 500 years ago, you basically don't need any money. You only need income today if you want to live at the quality of life that people want to live at today, because we have so much more abundance that we have accessible to us. So that's what real growth is. Growth is actually deflation. It's getting more for less. And that is confused when we look at things in dollar terms, because for a short period of history, compared to all of human history. For a short time, we've had a monetary system that is inflationary, which means the way that we store the value of our labor and the value of our exchange products and services is bleeding its value over time. And so we look at prices and we see them going up. When if the money supply never changed, we would all look at prices and see them going down. A very recent example of this is 1860 through 1900. In fact, it was like 1800 through 1900, but the Civil War, because they had a fiat currency then during the Civil War, there was this big spike of inflation. But if you eliminate the Civil War for like 100 years, what happened was the cost of living went down, even wages went down. But in real terms, wages actually went up. And so every year you'd get a pay cut, basically. So let's say this year you're making 100 grand. Next year you're making 99 grand. The year after that, you're making 98 grand. You're like, hey, I'm getting pay cuts. Well, the cost of living was going down even faster than that. So this year it takes me 100 grand to be able to live. But next year it only takes me 97 grand to live. So now I've got a 2 grand surplus. Year after that it only 95 grand to live. So this year I've got a 4 grand surplus. And so the just by saving, I'm increasing my value. My money goes farther and farther every year, and that's the path of all of human history. You get more for less. It's deflation. That's what growth is. That's only confused because we live in this fiat world where they're outprinting the real growth that is happening, and so prices go up. And that is a game that is destined to fail at some point. It's just a matter of when, not if, and it can last a lot longer than many people think. But it really starts to come to a head when you do have explosions in productivity, and things like AI are potentially going to do that because technology is deflationary. It is getting a lot more for a lot less. And so that means that on average, that will help push prices down. But if prices go down in an inflationary environment, the whole debt system implodes because it's built on prices continuing to go up. And so the long term is that growth means you get more for less. And it's only confused by the fact that when you price in terms of dollars, it looks like it's the opposite. Um, so, all right, guys, that is the end of the live stream here. Great questions today. Really appreciate it. And we'll see you guys on the next one.